All righty, well, let's get to it. Are you guys out there? Are you a first-time home buyer? Maybe you're a homeowner looking to refinance. Otherwise, why would you be watching a mortgage video? I'm just kidding. So what we're going to talk about today is the jobs report. The new jobs report just came in. It was actually fantastic. It was better, much better than everybody expected, even economists. So that's great news for the economy. It's not going to be good news for you homeowners out there. I'm going to show you how the bond market's reacting to this. So if you're a homeowner, home buyer, stay tuned. We're going to talk about where mortgage rates are going to go. We're also going to talk about oil, inflation, what my forecast is for next week, next month. Stay to the end for that. But without further ado, let's get over to where mortgage rates are. And thanks you for joining me today, folks. My name is Dan Frio. I'm the host of Rate Update. I'm also a licensed mortgage loan officer, licensed in all 50 states, as well as Puerto Rico. If you need some help with the mortgage, I'll give you all my information at the end of this video. So let's get to today's news. Here's what happened last night. So we go through here, and the biggest news this week was going to be the unemployment number. What that number is going to come in from the government. That's what everybody's been asking. So last night, I'm trying to do the research, and here's what you come across. Long-term unemployment is surging. In the U.S., there are hidden costs for workers and the economy. So you're thinking, okay, this is really bad news because the Federal Reserve, they watch where the jobs market's going. They're watching inflation. So you're thinking, okay, this isn't good news for jobs. Well, here's what we got. We got the report today, and let's show you what this comes in at. U.S. payroll rose by 172,000 in May, 1 month. That's a lot more than people expected, but it kept the unemployment rate sticky at 4.3%. So why is this so much bad news? Why is a good jobs market bad news when it comes to the economy? Let me explain it to you. The first thing I like to do each day is I like to start with a chart, and this chart's pretty bad. Okay, so all you have to understand is that number up through there. All that is if the number's red, that's not good news. If it's bigger than 10, that's even worse. So this means mortgage rates are probably going to go up about 0.1 to 0.125, about 1/8% today alone, just based on this number. So you're probably thinking, okay, we got a good jobs report, so why would the markets react negatively to this? Well, let me explain why. If you go over through here, here's where the 10-year Treasury is. I'll start with this. The 10-year Treasury yields shoot higher above 4.53 after a strong jobs report. Let me explain why. 4.5, that was the trigger point we were watching for. So this isn't good news. That's kind of a barrier. Once we pass that, then it might be up, and away from there. But let me go over and explain to you guys what's going on. So here's what the Federal Reserve looks at. Here's basically what the markets look at to figure out where inflation's going, and then thus where, they can figure in and tag interest rates. Okay, I'll explain it this way. Federal Reserve, they monitor that rate over there. It's called the federal funds rate. All it is interbank lending. It doesn't control your mortgage rate. It doesn't control your car loan or your credit cards. Now, once they adjust this, the markets usually adjust. But then the Federal Reserve monitors two main things. They monitor inflation, the PCE. Well, we know that's high. We're going to get a lot of inflation numbers next week. I'll give you my thoughts on that. We're going to give a recast of what's coming, or a look ahead of what's coming down the pike next week. But then they look at the jobs numbers. So here's what the Fed's looking at. They're like, okay, inflation's high. We know it's high because of oil. But let's get over to this jobs report. Let me show you the good news behind this. And again, if the Federal Reserve's looking at this saying, okay, the jobs market's good, meaning people are working, people are making more money than they were, and they're keeping up with inflation, and it looks like they're still spending, do we need to cut rates? So that's what's happening. So let's look at over through this. Friday, here's the numbers we just got. We'll go all the way down through 8:30. We'll go through piece by piece real quick. Average hourly earnings month over month. So how much did people's income increase? This is the averages. It's not everybody. But the last reading was 0.2. They thought it would go to 0.3, and it did. It went up. So people were making a little more money. Might not feel like it. Year over year, it went from 3.6 to 3.4. A little bit of a drop there, but you're staying with inflation. You're right about there. They're saying inflation's at 3.8. I'm saying it's 4 or 5 or whatever. But the new Fed chairman coming in, I think they're going to have a new model. We can even talk about that if you guys want to. Then here's where it is. Non-farm payroll. Okay, last reading was revised. It was up like 50, 60,000. I think this came in at 115 previously. It was revised to 179. That's a revision up. They thought it would go to 85,000. It went to 170. It doubled. So the market right now is saying a lot of people are getting jobs. Participation rate, good. It's staying steady. Payroll's good. It's staying at point, private payroll, and the unemployment rate. So here's the unemployment rate that we're looking at. 4.3 previously, 4.3 now, 4.3. So the Fed's looking at this way. Okay, so if you're sitting at the Fed, you're saying, okay, inflation's high. I shouldn't be cutting rates into a higher inflation market. And the jobs numbers, if this jobs numbers were weak, they'd be kind of at this point where, okay, maybe we got to cut because we're really deteriorating the job market. So now they're saying the jobs market's fantastic. Wages are keeping up. We're not going to cut rates. That's why the market's reacting. So let's get over to the news. Let's get to some next week news because this is also going to give us the inflation numbers coming down the pike. So this is important. I'll give you my thoughts on this, but then we're going to go over and back and look at what oil's doing, what the equity markets are doing, and then we'll recast back to the bond market here in a second. So next week, here's what we have to look into. We're going to look into what inflation numbers are coming down the pike for you and me, inflation on the consumer side. We're also going to look at where does all this start on the producer side. So what's coming down the pike next week? So this is as important as basically oil's going to be. So let's go to Tuesday. We're going to get ADP payroll numbers. That is starting to come in pretty darn good. So I will go over that on Tuesday. We're going to get existing home sales. Now, last rating we got was on new home sales. Remember I posted those videos? New home sales are down 11%. They're getting hammered. Well, this we're going to see what existing home sales are doing. Are they up or down? I think people are buying more existing homes than buying into new builds. That's just my thoughts on there. Then we're going to go down through here, and then Wednesday, what are we going to get? We're going to get the consumer inflation numbers, the CPI. Let me just go over briefly. There's going to be 4 reports coming out the same day. Might be a little confusing. So let's break it down because you have to understand the differences between this because some of these numbers have oil in there. So you know those numbers are going to be way inflationary, but then others take out oil. So how's those numbers look if we take out oil to pinpoint, is oil really the problem that we have right now? So on Wednesday, here's what we're going to get. We're going to get core CPI, and then it says MOM. That means month over month. Core, what that does is just think of it. They have this basket of goods and services, and they pull out just say gasoline. Okay, they pull out the gas and the food in that. Think, chicken, eggs, what everybody was complaining about. So you pull out those things. How's all the other items doing? Well, that's how they report it. So do I agree with it? No, because you and I still have to buy gas and eggs. But that's what they look at. But basically what they're trying to do is say, okay, is this the component that really is inflationary? Well, this is what this is going to tell us. Because then we're also going to get the CPI, which includes that energy numbers. So if you have energy in here really going up, well, and then you have a benign core, well, that's really pinpointing it to oil. So we're going to see how those numbers come in next week. You're also going to get initial jobless claims and continued claims on Thursday, and then the PPI right through here. PPI, it's going to give us a whole slew of numbers there. The PPI is producer inflation. So we've got a whole bunch of things coming down the pike. But let's go over to see what the markets are doing right now. We're going to go to this piece right through here, go to CNBC, and we're going to go see the Dow Jones. Everything's in the red. Why? Well, let's look at oil, see what oil's doing. Oil's in the red. So let me kind of explain to you guys what things are going on in the background. So yes, oil is down. This is great news. Needs to get down below $90 a barrel, but that's good news. It's also, that's giving us that piece of the puzzle over there. The U.S. equities, here's what a lot of things are happening in the NASDAQ. Now, these are reports from CNBC and Fox News. They're saying a lot of people are getting out of these tech stocks because they made a lot of money. So they're getting out at the top, and they're moving their money because we have 3 huge IPOs coming out. It's SpaceX, I think it was, and there's Anthropic and a couple others. There's 3 major IPOs coming out, and I think they're saying people are liquidating a lot of these things to get money on the sidelines, like dry gunpowder, to put those investments in place. So that's what a lot of analysts are saying. I don't know. I'm going to go with what they're saying because right now the earnings reports are looking fantastic, and I think it might just be profit taking because just think, right before the war, right before the war, the Dow Jones hit 50,000 and then it retreated heavily from there. And then people were saying, okay, this is that crash. We told you it was going to crash. And I kept saying, don't get out of the market. If you didn't, you're way up at this point. So even if you stayed in the NASDAQ, I think the NASDAQ's up about 18% since the war started. So that's what we're seeing through there. So we're going back to oil. Oil is retreating. Pay attention to this. The Iranian situation, it is still the biggest newsprint in the markets that we have right through now. So let's get over to see what the predictions markets are saying. I want to understand, when is this U.S. gas prices going to go down? So U.S. gas prices, next Fed hike. Well, let's go over to this. This is just what popped up. Before 2027, they're going to hike before July of 2027. So the Kalshi report, I don't know if you guys can see this. This is saying they're expecting a rate hike by the Fed before July 2027. Okay, so let's go out here and see what my thoughts are. So if you're a bettor, I'm not saying you should, but let me just give you my thoughts on this, and then I'll give you my forecast. Thanks for staying till the end. Am I locking in our clients, or what are we doing? What are we advising our clients to do? Well, let's get over and see what the Federal Reserve's telling us they're going to do. So in 12 days, the Federal Reserve's going to meet. We're going to have a live event at that point. Remember, next week, we're going to come in daily. Monday, Wednesday, and Friday, those are going to be our live days. On Tuesdays and Thursdays, we're going to have a different format. We're going to post videos that you can understand programs and how to use, different mortgage products to help you make housing a little more affordable. But here's where the markets are telling us. This is from the Chicago Mercantile Exchange. This is based on options and things like that. They go through here and they're saying, okay, what's the Federal Reserve going to do? Well, the federal funds rate right now is 3.5 or 3.75. So you look at that. Well, it's blue all the way down through here. So they're saying now in March of 2027, they're going to hike rates. Now, if I'm betting on Kalshi, which I don't, and I'm not advising you guys to do, is I would say the next thing is not going to be a rate hike. It might be a rate cut. And I might be at odds with people, but only time's going to tell. So what am I advising my clients to do? Well, let's get to that. So here's what we're telling them. If you get a contract in right now, we're locking you in. Here's why. Look at what happened today. We got the MBS market. Let's go back to that. It's down 50 ticks. Okay, mortgage rates are going to jump. They're going to jump at least 1/8% today. This is the perfect example of why we're doing what we're doing. So now let's go back to this piece of the puzzle. Now, if you're looking to refinance, or maybe you're looking to buy in the next few months, what should you do? Subscribe over there. I'm going to explain every day the market news that's coming currently and down the pike that should be affecting rates. If I'm sitting on the sidelines right now and I'm looking to refinance, I'm holding. I'm getting all my information ready, because when rates come down, remember right before the war, rates were at 5.99%. So I'm looking to get ready for that situation. But if I'm looking to buy, I think you should get pre-approved, and make sure you get pre-approved at a rate it's 3/8 higher than where current rates are today. Why? Well, because if this happens, you're protected. If you can afford that payment, then maybe housing's in the cards for you. So if you're a homeowner, home buyer out there, go to my website if you would. Check out the rateupdate.com. If you're a homeowner, putting all your mortgage information into this RateWatch 2.2 will track rates for you and also mortgage payments. So give you opportunities to refinance when that rate and payment's just right. If you're looking at debt consolidation, see if it makes sense to you. Check out our debt consolidation tool right through here. But if you're a homeowner out there, you're a realtor, maybe you're a loan officer, you're just trying to track rates, click our mortgage rate trigger right through here, and it'll bring you right up to the screen that we have here. So that's our report for today, folks. Do we have any questions out there? No Statler, nobody out there needing any questions answered for today. So let's go back to where the MBS market is, because what you have to understand, like I said, is a good jobs market means the Federal Reserve can sit on the sidelines and wait a little longer. So if you go back to the MBS market, we are down 50 ticks. That is not great news. If we look at a 2-day chart, look at that move. That is huge. Think if that was your stock, you'd be sitting there saying, wow, I wish I sold. Well, the same thing with people that were floating their rate. They're looking back saying now, boy, I wish I locked in. Looking at a 5-day chart where we're going to go in, we're back, well, rates are higher than where we started the week. That's not good news. But you knew that was coming. We didn't really predict this piece of the puzzle. But today's shocking news on the jobs report, now you understand a little more of why a good jobs report is not great news if you're out there looking to buy that first house, or you're just trying to make housing a little more affordable. Statler, you're here, my man. So let's see what we got here. Let's post this up. Inflation is not causing demand demand destruction, which is causing more inflationary pressures. Makes sense. The money is saying the Fed rate hike is on the horizon. Good morning, Dan. Good morning. So let me see. Inflation is not causing demand destruction. Yeah, you're right. Makes sense. The money is staying at Fed rate hikes. Is on the horizon. I don't think I'm still going to be at odds with you. We'll check and see how time goes. Here's what my predictions are, or my forecast, or I'm going to say, it's not even my hopes, I guess. My expectations are the war's not going to last forever. Okay. And once this is over, we're going to pay attention to next week's numbers. We're going to truly pay attention to those core numbers. Is it really oil that's causing the inflation? That's what we're going to see next week. We're going to have all the core numbers on the consumer side and the producer side. So next week's going to be pretty darn interesting. Kyle, good morning, Dan. What are the jobs that get reported? Does that include part-time, like Uber jobs like that? You know what? I'm not quite sure. I did watch the jobs numbers. I don't know. I honestly, I don't know if a full-time job or a part-time job is included in there. That's a great question. But what the numbers were, if I wish I could break it down, but the numbers were really good. You had services and hospitality, you had construction, you had a lot of diversity in the jobs numbers. It wasn't just in services. It was all over the map, and they were going, both CNBC, Bloomberg, and all those were coming in saying, okay, it looks like a pretty balanced jobs report. So again, it's not skewed one way or another. So this jobs number actually shocked me. I figured we were going to be pretty good. The JOLT numbers, a lot of things were telling us some good news, but yeah, this number was shocking. Let's see what you got, Sadler. What would make you think the war is more long-term? Is going beyond June? What is the last holdout? You know what? I'm the war. What do you think the war is more long term? What would make you think? I'm not saying that. I wasn't saying the war long term. I'm just saying I don't know how long this war is going to last. I thought it would be over in weeks. I didn't think it would take 3 months or so. A lot of the predictions markets, if you go over to Kalshi right there, and then this isn't me. Let's see, number of cuts, Fed decision. Let's see if we can go to what do we got here? I don't know how to find this. Political trending. Let's go to trending. It's got to be in trending somewhere. Will Congress salaries increase? I hate that question. Peak U.S. national debt. Will tariffs hold? Yeah, I can't find it. Here's my thoughts, and this is what my forecasts are, and I'll stick by it. Is the war's going to end? It'll end soon. How soon? I don't know. If you look at a war, most wars you think last a couple years. Well, a lot of these are, I hate to say excursions, but they don't last very, very long. This one's lasting a little longer than expected. And it's really not a war. It's just kind of a standoff. Think of it that way. There's not millions of people dying each day. So how long is this standoff going to last? So once the standoff is over, and you got to think of it as we're just standing there waiting, okay, what do you want to do? Because if not, we're just going to come in and kind of do what we got to do. And do you agree with it or not? That's not me to say, and that's not for you to say. They're going to do what they need to do. But it's going to end soon. And then as these numbers come in eventually and show us the inflation, how the inflationaries, gets affected with this, that's what's going to move the markets. So, okay, great. Thanks, information there. So, Statler, if you'd ever want to reach out to me, give us a call. You can call the number down below. Send me an email. It's dan@therateupdate.com. But that's basically it for today. So we got some news coming down the pike next week on the CPI and the PPI. Let's go back and end with the chart for the day. That is the MBS. We are down 48 ticks. So I'm expecting rates to go up 6.625. That was my expectations right through this, but the markets can move on a drone strike or a peace agreement. So stay tuned, subscribe over there, and don't forget to check out our website, therateupdate.com, if you need some help with a mortgage. Thanks for watching, folks. God bless. Have a fantastic weekend. I'll see you back here Monday. Remember, next week we're live Monday, Wednesday, and Friday. Tuesdays, Thursdays. Watch for those videos. They're going to be